Most people think the death tax is just for billionaires. You see the headlines, right? The federal estate tax exemption is almost $14 million, and you think, whew, I'm safe. Well, I'm here to tell you that if you live in one of 6 specific states, that belief isn't just wrong, it's dangerous. Because there's another tax out there, one that hunts the middle class from the very first dollar.
Okay, so let's break this down because it's a tale of two completely different taxes. On one side, you've got the federal estate tax. That's the one everyone talks about. And yeah, with that massive exemption, it really is a tax for the ultra wealthy. But then you have the state inheritance tax. This has nothing to do with giant fortunes. This is a tax on the simple act of receiving property, and it can kick in immediately, often with zero exemption. And this right here is what creates a just devastating liquidity crisis. Think about it. Your kids, your siblings, they might inherit a house worth hundreds of thousands of dollars. But the state doesn't want the house. They want cash. And they want it within months. If your family doesn't have that cash just sitting around, they can be forced to sell the very home you wanted them to have just to pay the tax bill. It's a tax on the living, and the fallout is immediate.
So to protect your family's legacy, we have got to dismantle the single biggest misunderstanding about all this. It all boils down to one simple question. Who pays the tax? Is it the person giving the money or the person receiving it? The answer, my friends, changes everything.
The federal estate tax is what we call a giver tax. The tax is figured out based on the total value of the estate, the whole pot of assets, before a single dollar is handed out to the heirs. But because that exemption is so incredibly high, almost nobody pays it. This is the tax that gives 99% of American families a totally false sense of security. Now flip that concept completely on its head. The state inheritance tax is a receiver tax. The burden falls squarely on the person getting the inheritance. And here's the kicker. The tax rate is decided entirely by how closely they're related to you. Your son pays one rate, your sister pays a much higher one, and your nephew, well, he pays an even higher one. In this system, your bloodline literally determines your tax bill.
The good news is this tax isn't everywhere. The bad news? It exists in a very specific geographic corridor of 6 states. If you or your family live in one of these so-called dirty 6, you're playing by a completely different set of rules. Your legacy is exposed to a risk that the rest of the country just doesn't have to worry about.
So here's our high-level threat assessment. Each of these states has its own little trap. Pennsylvania has what we call the sibling trap. New Jersey is famous for the nephew penalty. Maryland hits you with a double dip, 2 different taxes. Kentucky and Nebraska go after more distant relatives. And Iowa, well, Iowa is the light at the end of the tunnel. But as you'll see, timing is everything. Let's start our deep dive in what is, without a doubt, the most aggressive state on this list, Pennsylvania. Now, most states with this kind of tax will at least cut the direct kids a break, not Pennsylvania. Your own children will owe the state 4.5% on every single thing you leave them, starting from $1. This chart just lays out the brutal math. A spouse pays 0, that's normal. But look at this. It jumps immediately to 4.5% for a child. Then it nearly triples to 12% for a brother or sister. And for anyone else, a niece, a nephew, a best friend, it hits a staggering 15%. Let's just focus on that one number for a second. 12%. That's the bill the state sends your brother or sister for the privilege of inheriting from you. This isn't a tax on the rich, you see. It's a tax on having a close family. And here is how that 12% destroys lives. I call it the Golden Girls trap. Imagine 2 elderly sisters who've lived in the same home for 40 years. One passes away, leaving her half of the house to the other. On a modest $400,000 home, that surviving sister, who's probably on a fixed income, is suddenly staring down a $48,000 tax bill, due in cash. If she doesn't have it, she could lose her home. Okay, let's head over to New Jersey because the threat evolves here. The Garden State uses a very strict class system. If you're in the right class, you're golden, you pay nothing. But if you fall into the wrong one, the tax is absolutely punitive, and it triggers on an amount so small it's honestly insulting. Just look at this disparity. Class A, that's a spouse or a child, they pay 0. Safe. But a Class C beneficiary, like a sibling, gets hit with an 11% tax on anything over $25,000. And then you have Class D. This is your nieces, nephews, friends. They pay 15% on anything over a mere $500. Let me say that again, not 500,000, $500. Let's put a real number on that. We call it the nephew penalty. Say a single aunt leaves her $500,000 condo to the nephew who took care of her for years. Because he's a Class D beneficiary, he personally owes the state of New Jersey $75,000 in cash. He inherited a home, but he's facing a bill the size of a new luxury car.
All right, rapid fire through the other four. Maryland is the only state that gets you with a double whammy. They have both an inheritance tax and their own state estate tax. In Kentucky, cousins and friends face a steep cliff, paying up to 16% with just a tiny $500 exemption. Nebraska is wild. The county collects the tax, not the state, and they hit more distant relatives the hardest. And then there's Iowa, which is thankfully getting rid of its tax. But if you're settling in a state from before 2025, you're still on the hook.
Now, at this point, I know what a lot of you are thinking. Okay, fine. I'll just give my house to my kids before I die. Problem solved. I am begging you, please listen to me. This is the most common DIY strategy people try, and it is a catastrophic mistake.
The logic seems to make sense on the surface, right? A parent signs the deed over. When they pass away, they don't technically own the house, so it can't be part of the estate to be taxed, right? Wrong. The state revenue departments have a special name for this move, a gift in contemplation of death, and they have rules specifically designed to shut it down.
You see, these states have what are called lookback periods. Pennsylvania looks back 1 full year. If you gift your house and then pass away within that year, the state legally reaches out and pulls that house right back into your taxable estate. It's like the gift never happened. And New Jersey and Nebraska, they look back even further, 3 years. They will audit those transfers, and if they think you did it just to avoid tax, they will tax it anyway. But here is the final brutal twist. Not only does this gifting strategy completely fail to avoid the inheritance tax, it actually creates a second, totally separate tax bomb. When you gift a property, you rob your kids of a massive federal tax benefit called the step-up in basis. Normally, when you inherit a house, the tax basis resets to what it's worth on the date of death. So if your kids sell it, there's little to no capital gains tax. By gifting it, you erase that benefit, and you could stick them with a huge capital gains tax bill on decades of growth. It is a double taxation nightmare born from a simple mistake. So, this all brings us to the one question you have to ask yourself. And it's not about how much your assets are worth on paper. It's about cold, hard cash. When that day comes, is your family's legacy liquid enough to survive when the state tax collector comes knocking on the door?